All right, good afternoon, everybody. Welcome to the Polaris Trading Group PTG University Educational Workshop Series. Today's Wednesday, June 18th, 2014, and today's topic will be the balance chart components. Okay, on the next slide, we're looking at the balance chart components. Now, there's several components of the balance chart, and we'll go over each of those by definition, a little description, and then we'll take a look at each of the components on the balance chart, and we'll actually build the balance chart with all the indicators. So the first indicator that we'll look at is referred to as the opening range rotation indicator. Again, these are all indicators. In the opening range rotation, simply the ORR defines the initial 5-minute opening range and calculates the median level of this period. Now, this level forms the basis of our opening range trade strategy, of which we have documentation on the members' website. All right. The next one is referred to as the opening range, and this defines an initial 30-minute period. Now, some people out there use a 15-minute opening range for the S&P. Generally, it's between the 15 and 30-minute. Doesn't really matter which one you use, as long as when we use that, we stay consistent with it. And again, this is a period whereby the participants initially probe upper and lower boundaries to see how far they can push it. All right, it's a little different than the initial balance, but it's during that opening period. So you have the opening range rotation, which the market makers get all the initial orders out of the way, and then during that first 15 to 30-minute period, and of course at the 10 o'clock time period Eastern time, there's usually an economic report release of some sort. So a lot of people use that first 30-minute period. So they probe the upper and lower levels to see what the initial boundaries were. Once they have kind of those in place, there's further activity that takes place in the second half hour, which pushes us out to the first 60-minute high-low range, which is referred to as the initial balance. Now, the initial balance is a market profile type term, all right, and it is a standardized term, vernacular, that is used out there. So we will be referring to the first hourly high-low range as the initial balance. And this is a time where the institutional money managers use a range to determine day type. Now, there's various day types. We won't get into those today, but there are day types. But simply, the categories is whether or not the market's first hourly action is developing as a trend day or as a range day or non-trend day, and in which case, once they've determined what type of day the market is unfolding at, they begin to then enter their trade strategies for the remainder of the day. Now, there are a lot of money managers out there that I've worked side by side with that do not trade for the first hour of the day. Now, you may think that odd, but a lot is predicated on that first hour initial balance range. And these money managers, many of them need to get the day type correct, and that way they can implement their strategies accordingly. All right. The next one is fairly simple. It's called the median point or the midpoint, and that simply calculates the dynamic 50% level of the current session. Now, this level is used as simply as an over-under, or we can refer to it as the bull-bear line, all right, for the day. And as we've seen on many occasions, prices tend to return back to prior days' median levels. Okay, so we also refer to that as the volume trend point of control or volume trend midpoint, and so that becomes an important level for the next day. All right, so but as it's developing throughout the course of the session, it's just simply referred to as the median point, or MP. And next is the volume at price. Now, this is a dynamic developing volume profile, and which displays simply the distribution of prices traded at various price levels. Now, volume profile can be looked at on various time frames. Simply this one that we use on the balance chart is the current session, and day session only is what we use. And then now the next component of the balance chart is the average daily range, or the ADR 10, and 10 stands for 10 day. So this calculates the 10-day average daily range. It's different, slightly different than the average true range calculation. And this projects an upper and lower range values. A lot of professional traders out there use the ADR to calculate price target projections. It is similar to the 10-handle rule. Many of you are familiar with the 10-handle rule, but beyond the 10-handle rule, the 10-day ADR is simply a calculation of a dynamic rolling 10-day average. All right, and so we want to be in alignment with that on a kind of a bigger picture basis. The PTG D-level money box, DLMB, that is simply the levels, the static levels that we calculate based upon the prior day's range, and their expansion levels, and those levels are the 113.5%, which identifies the D level, and the zone between the 1272 and the 1382% range expansion is referred to as the money box, and that is of the prior day's high-low range. The target master, many of you are familiar with. Simply this displays a normalized 3-day and or a 5-day range, and there are specific proprietary calculations, all right, that go into that calculate what we've referred to as breakout and breakdown price levels, and there are 3 of them to the upside and 3 of them to the downside. We saw actually today we hit a couple of those today as well in today's action. And then the last one that rounds out the components is the volume trend histories. All right, VTHIST is what it'll look like on the chart, and this calculates and displays 10-day histories of the volume trend point of control, and simply they're also referred to as the high volume nodes, all right, for each day. And they're the greatest single level of price acceptance between buyers and sellers. Okay, so that rounds out the components definition, and let's just get to the chart, and we'll run through each of these sequentially, and then we can discuss a little bit the nature of them. I won't get into super detail on how to use each of them, but we'll give you a brief overview. Again, like the opening range rotation, the opening range indicators, they are all part of the opening range strategy. So that is all part of the another area of the education that we have in documentation. So, but I will refer to that a little bit and show some examples. Okay, so let's get to the charts. Okay, so what we have here is the ES day session 5-minute S&P E-mini chart, and this is the core chart that we will use for our to construct our balance chart. The 5-minute is an important chart as it gives us some timely information in terms of swings. It's an intermediate time period for us as day traders, and so we can calculate simply all the levels off of that. Now, the first component we're going to load up is referred to as the opening range rotation, or the ORR. So give me just a moment, I'll load that to the chart. Okay, so the chart we have up here is, again, the 5-minute S&P E-mini, and we've overlaid the opening range rotation indicator. Now, again, the opening range rotation indicator defines the initial 5-minute opening range and calculates the median level of this period. Okay, so, and this is a core component of our opening range strategy. So simply what you have here is you have the first 5-minute bar, and that's simply why we use a 5-minute chart. This is part of that opening range strategy. the opening range high, the opening range low, and simply the median point, the 50% point. Okay, and so each morning, many times the market gaps up, gaps down. The S&P generally does that on a day-to-day basis. All right, it's and what this essentially does is it gives us the first look of what the sentiment is for the day. So when there's pent-up demand overnight, any geopolitical decisions, happenings that affect money managers' decision making for the next day's trade on the opening, all the pent-up buy and sell orders are executed, within a 5-minute period. Okay, is an acceptable time period. So what it simply does is it identifies the first sentiment for the day. It's the first benchmark, or short for benchmark, we just simply call marker. So it's our first marker for the day. Okay, and you'll see in a case like this over here, okay, where on this particular area here, with the market opens slightly down, all right, but within the context of the prior day's range, and but it was weak on the opening. Okay, and then so that first 5-minute high-low midpoint is set in place. Market comes down and makes a new swing low, and then bounces back to about the midpoint itself. Okay, at that point, what we're looking at, since this is the first dynamic sentiment look of the day, you can think of it as an over-under line. Okay, for the first look. So bearish below the midpoint, and of course below the 5-minute low. All right, bullish above. So with the market gapping down, it's not a huge gap, but with the market gapping down, any retracements back up to the midpoint, all right, will be potentially first level of resistance or resistance zone. So during this first 30 minutes or so, 60-minute sequence here, okay, and again, that's all part of that initial balance that we'll talk about shortly as well. As prices staying below that 5-minute average, this is continuing to show weakness. Now, it did stop here at the prior low, traded there a little bit, but never really recovered to get back above that 5-minute average. And when that first initial balance, first hourly high-low is ultimately put in place, which we'll see shortly on the next couple indicators, the big institutions take a look at this action, and they recognize that potentially for the day type is going to be a trend day down, potentially. Okay, but what they do know for a fact is that price is weak. All right, the participants out there buying and selling, the dominant force at this particular point is down, simply because the price was not be able to get back above the 5-minute average. All right. There are days where prices will trade around the 5-minute average, and it'll be used as support points. So here's a case where on the next following day, okay, here's your 5-minute average here. Price rotated down, all right, but was not the opening range here opened inside the prior day's range, pulled back. All right, yes, it was below the 5-minute average, so initially it was bearish. Okay, found support at some prior lows, and then rotated and auctioned back up. So once it got back above, all right, the 5-minute zone. Okay, now notice it didn't stop there, so there would have been a potential for resistance there, but the resistance never developed. Okay, so the dynamics that particular day called for stronger action. Now we want to be on the alert for a support or resistance as prices return back into that opening range, and specifically the opening range midpoint. So as you can see, it rotated up and then ultimately came back down and retested the opening range average a little bit later on, early afternoon. It held, all right, so since price was above it, it held a couple times, tested it on a couple occasions here, and then ultimately price held above that, and then late in the day tested it once again, found support. Okay, and I'm just kind of describing the dynamics here. And then the following day, yet again found support within the context of that opening range average. So throughout the context of the day, it is important. Now, it is generally seen as most important early in the morning, right, as it's referred to as the opening range. But it does matter as the day unwinds as well. And here's a final example we'll go over, and then we'll add to the next layer of indicators. The 5-minute opening range on this particular day, price rotated fairly aggressively outside the opening range and then retraced back into the opening range zone, found support. Right, so buyers were aggressive on the opening. All right, is referred to as an opening drive sequence here. Ultimately retraced, and then we would be expecting and anticipating that opening range to find support. So we would be looking to take long positions in an example like this on this type of a retracement. Okay, so again, the opening range 5-minute high-low midpoint is a core component of our opening range strategy. So during your educational studies, by all means review the opening range strategy documents. All right, so what we'll do is we'll add to the next layer of indicators, simply called the opening range, and it's really very similar to this, but it's just an extension of the opening range rotation. So give me a moment, I'll put that on the chart. Okay, what I've done here is I've added a layer indicator called the opening range. Now the opening range, we define the initial 30-minute period, and again, it's whereby the participants initially probe the upper and lower boundaries. All right, so during that first 30 minutes, all right, the market's active trying to find an initial range, okay, beyond the opening range rotation, which is specifically designed for kind of clearing out the opening orders. Now, once all those opening orders are complete, all right, the next phase, all right, and again, as the market unfolds throughout the day, there are phases of activity. The next phase is the market participants want to measure what that 30-minute range is. And once that 30-minute range is established, and again, what we do is we simply mark the 30-minute high, 30-minute low, and the 30-minute median point. Right, just the same way as we did on the opening range rotation. Okay, and these become initial boundaries, all right, for the market to have probed up and then test, and then we use those as markers as the days unfold, and to determine whether or not the market has strength directionally. So on this particular day here that I'm pointing to, if you recall, we just discussed that the market had an opening drive auction, pulled back in during the opening range, back to the opening range, found support. We were anticipating support there, and then as price rotated back up in a more trend-like fashion, once it there could be resistance at that 30-minute high, but if that 30-minute high does not elicit a response, okay, to stop the price movement, all right, what we have here is you'll see these layered lines here. The green one up here and another green one up there. These are the 30-minute price targets. So the idea here is if price can get above the 30-minute high and convert, meaning holding above it, so penetrate above and hold above it, okay, there's a fairly high probability, okay, that prices will reach the initial target, 30-minute target. As you can see here, prices did reach that, kind of stalled out a little bit and kind of chopped around, in stair-step fashion, but it reached that first initial 30-minute target. Okay, you will notice this many times, okay, that this occurs following the next day here, all right, which is, I believe, today. The market opened pretty much in range, 5-minute average, 30-minute high-low midpoint as well, pretty neutral here. Price rotated down, right, and notice where it found support. Okay, it found support, all right, at the first target of the opening range. That's the 30-minute high-low. also corresponded to the 30-minute breakout point, okay, in the prior day's range. So this became an opportunity here in today's session to have bought the pullback around those 31. So as I've mentioned, these levels, all right, although calculated for the individual day, we really must not necessarily take them in isolation. We want to look at the prior day's levels as well, because they become useful for us, right? Because the market is just very fluid. The market just doesn't stop at the end of the day, but technically the pit session does have an opening and a close, and we use that to our advantage. Okay, so these two form the opening range strategy. All right, the opening range rotation and the opening 30-minute opening range, and with price targets. Okay, next layer we'll add on, and what I'll do here is I'm going to take these two off, and then I'm going to add on just singularly the initial balance levels. Okay, on this next chart, what I've done is I've taken off the opening range indicators that we've just discussed, and I've put on the initial balance indicator. Now the initial balance indicator is the first 60-minute high-low range, and again, this is where institutional money managers use it to determine a specific day type. Okay. Now these paint automatically at the end of each specific period. They are labeled. Okay, on the right-hand side here, let me just move this over, and you'll see some labeling to them. You'll see the initial balance midpoint here, initial balance high, initial balance low, and then there will be two targets, target 1 and target 2 to the upside as well as to the downside. Okay, so just want to move the chart over just a touch and take a look at this particular day. Now this particular day here on 6/16, again the market opened and it had a fairly wide it actually had a fairly wide opening range as well as an initial balance range. So the initial balance first hourly high pushed up to this level and then ultimately pushed back down to form this lower level here, all within the context of the first hour. So the opening here and then the initial balance high, okay, and you'll notice here that the low price came in after the initial balance low was put in. So the initial balance high low was defined as the opening price low, and then the push up to establish an opening the initial balance high up here. Now on this rotation in price all the way back down, notice where it found support. It found support back at the initial balance low period, all right, and never broke that. So here's something, a day type. All right, when we have a relatively wide initial balance, okay, when price has an initial wide, and now again, wide is a relative term, but and there's no specific definition in terms of, well, what constitutes wide. All right, is 5 points, 10 points, 12 points, 15? You know, what really constitutes it? Not quite defined, because that's simply kind of in the eye of the beholder in terms of their own personal calculations. But simply, I kind of estimate a wide initial balance as 10 handles. All right, so just kind of going with the guideline of the 10 handle rule. Okay, so 8 to 10 handles is a fairly wide initial balance. Now, when you have a wide initial balance like that, you tend to have a range type day. Okay, if you think about this for a moment as a comparison, look at in terms of a football player. Okay, a lineman down on all fours. Okay, when a lineman is down on all fours, it's very, very hard to move him. Okay, so he has a wide stance. All right, so the wider the range, the harder to move it. Now, there's a lot of freedom to move within the context of the range. All right, but the upper and lower boundaries are pretty solid. okay? And in order to expand this range, it's going to take a lot of energy. All right, so just think of it in those terms. Now, on the other hand, when we have a relatively narrow initial balance, okay, and today was actually a very good example, okay, so you can see on this chart over here to the right hand side, today's date, the initial balance high, the initial balance low was only 4 points, okay. Now when you have a narrow, relatively narrow initial balance, okay, range expansion outside of that first hourly high-low, all right, is fairly easy to move, okay. Think about a ballerina in this example, all right. So you know how the ballerina, spins, okay. Well, if you pushed on her, okay, she would kind of move quickly, right? She would just kind of topple over a little bit, easy to move. All right, as opposed to that football player. So when you have a narrow initial balance, all right, the tendency will be for range expansion. Now again, what is a relative, narrow initial balance? Well, you can see here 4 points is relatively narrow. All right, I think 8 points would be fairly stable. Anything beyond 8 points would be very stable. Okay, so you can use some of those as some guidelines. Here with the 4 point range, you can see a push down below the initial balance low, all right, found support at the first target point, okay? And again, at this push down again, all right, found support yet again at the initial balance target 1 level, okay? And these are pretty much symmetrical levels, so how I get the targets here is very simple. All right, you take the midpoint, okay, of the initial balance to the low, okay, that is equal to that range, okay, so 35 to 33, that's 2 points, okay, that's equal to 33 down to 31, okay, so that's 50%, okay, of the range. And then 100% of the initial balance range, so that's the 37 through 33 here, okay, measured from the low, okay, gives us a target level 2. So very symmetrical. All right, and we can do the same thing to the upside and reach targets up above. So again, the idea here is with a wide initial balance, all right, we have a tendency of a range type day with a narrow initial balance. There is a higher probability, all right, not guarantee, but probability of an expanded range day. So they tried to expand the range to the downside, all right, did find support. Again, double support here, simply a double bottom support, and then a break back above, right, the initial balance midpoint today. Of course, we had Fed day today, so that kind of helped accelerate the price move. But a double bottom with a break above what we refer to as the mid pivot, in this case the initial balance midpoint, all right, gave us a solid breakout signal, all right. And then the upper targets to be shooting for would be, again, the initial one would be the high. That would have been fairly easy to break through. And then the next one you'd want to be looking for is the next level at 39, and then ultimately 1941. Now this is based solely upon the initial balance range. Now we have other targets, target master, stat X zones, and so forth. Okay, so these are the first 3 core components that we have, okay, for building our balance chart. Okay. And let me add on the next one. Okay, the next component of the balance chart we'll just take a quick look at. It's fairly simple calculation. It's the median point, and what simply calculates the dynamic 50% level of the current session. And this level is simply used as a dynamic over/under, okay, or bull-bear level. Okay, so the 3 most important levels you want to always be aware of on a day-to-day basis is the high, the low, and the midpoint of the daily range or any swing range that you're referencing. So any swing high, low, you want to know what that median point is, because that always acts as a dynamic bull bear line. So this particular indicator here is a static one based upon the prior days, or the current day's high, low, midpoint. So for instance, all right, the high, low range here, okay, this point right here calculates the midpoint of it, okay, and as price makes a new high or a new low outside of the current range, the indicator ratchets, up, or it ratchets down. So in this case here, the midpoint on this particular day yesterday was here initially, and then we made a new low, okay, and you can see here it ratcheted down, and so this becomes our new dynamic bull bear line throughout the course of the session. You can see today, all right, fairly wide session here. The initial midpoint here was down around the 1933s for a better part of the day. Of course, Fed announcement, all right, came out, and price rocketed quite a bit higher. So on the close, each time it made a new high, the midpoint kept ratcheting up, and on the closing midpoint is 39 3/4. Okay, so so at some point in the future, okay, if price does ultimately retrace back down, this 39 3/4 40 level will be an important point to consider. All right, and so it just simply highlights a dynamic bull bear line, okay, for us, and many times price will return at or near that line, and it acts as a support or resistance level. Okay, so it's a very simple calculation, just simply a dynamic bull bear. Okay, let me add on the next price one. Okay, so on the next slide here, indicator, this is, we refer to this as the volume at price chart, and simply it's a profile that is dynamically created throughout the course of the session and attached to the right hand scale here. Simply it represents the dynamic developing profile, okay, which displays the distribution of prices traded at various price points. Okay, and you can see here there's a cluster of volume on here, so the largest area of volume represents a great area of acceptance. All right, and then as price today, we got a breakout, so there was trade along each price point. Did not spend a lot of time there, nor there was a greater number of volume until near the close, where a lot of the buyers and sellers came in. So there was an explosion of volume here today at the close. But simply, many of you are familiar with this, and this is just simply a volume at price chart. Okay, the next indicator on the list here is referred to as the PTG average daily range, ADR 10. And what this does is it calculates the 10-day average daily range and projects upper and lower range values. Okay, so on a day-to-day basis, I discuss, or in the room, or at least I highlight for the membership in the room, what the 10-day average daily range is. Okay, and in this case here, this the indicator down below. Now this is for TradeStation. Okay, this is not yet coded for NinjaTrader or Sierra Chart, but it's on tap to be coded during the summertime here. Okay, so I am introducing this in this video for TradeStation users currently, but it will be coded up and available for the other two platforms, not in the too distant future. So simply, the average daily range is it takes simple average of the past 10 days. Okay, high-low ranges, and it creates a rolling number. You can see here this red line here where it says 11. Including today, the average daily range for the past 10 days is 11 points, high-low. That's generally in the low end of the distribution range. The typical historical range is around the 16 to 18 zone, so we're well below the average daily range historically. What the histogram shows is simply on any particular day, what is the actual value of that individual day's range relative to the average day's range. So you can see today here we have a green histogram, and we have a line here, a blue cyan line, that's above the average daily range. So today's range, okay, is 21 points, all right, 21 handles. And simply that is 10 handles higher, okay, than the average. So if the today's range is greater than the average range, it shows a positive histogram, and vice versa. So simply that is that particular calculation in display. Now what this does is it simply calculates dynamically the current intraday low or the intraday high. So let's take a look here. Today's low is 1929.25. Okay, the 10-day average daily range is 11 points. Okay, so 1929.25, right, plus 11, and so 100% of the average daily range, all right, would target the 1940 quarter. Okay, so simply taking the 10-day average daily range, adding it from the low, 100% of it brings us up to 1940 quarter. Okay, on the flip side, okay, whatever the current high is for the day, this is a dynamic indicator, so it constantly calculates throughout the day. It takes the average daily range and subtracts it from the current daily high, whatever that may be that day, all right, as it's developing, all right, and on the opposite side, all right, from the high, less 11 points brings us to the average daily range, in this case, of 39 quarter. Okay, so 50 quarter less 11 is 39 quarter. So simply, it takes a measurement off of the current low, adds the distance of an average daily range, all right, to get 100%. So what we want to know, what this does then, is how is price, where is price, all right, it answers the question, where is price relative to the average daily range? Okay, is it above it, is it below it? What is the average daily range? So again, similar to the 10 handle rule, in that in the 10 handle rule says whatever the low is, add 10 points. Whatever the high is, subtract 10 points. Okay, now that doesn't mean you're going to be buying off the low perfectly and selling off the high perfectly. It just means it's a guideline for traders. So if they buy off the current low, they can then make a quick determination of where the 10 handle is. Okay, so if you bought off 31, okay, well the 10 handles would be 40 and a quarter. Okay, simply, many traders, professional traders, use this average daily range as a guideline because they need to know, they want to know, well, where is price relative to the average daily range? Is we above it? We below it? And what percentage of that average daily range, is price currently trading? Okay, and a pretty good guideline is the 75%, okay, value. So again, 75% of 11, okay, added from the low gives us a value here of 1937.50. Okay, so at this point, okay, this area right here represents 75% of an average daily range. Okay, and then what we do here on this particular indicator beyond that is we calculate anything beyond the 100% ADR value, we simply are, calculate some familiar levels. All right, the 113, all right, kind of the D level, all right, the 1272, all right, beginning of the money box, and what we made an adjustment here, instead of the 1382, the Fibonacci 1.1612, all right, 162% of an average daily range. Okay, so this is a way that, and again, which one of these values is important? They all could be at any point in time. Okay, this is designed for establishing targets. Okay, these are not necessarily designed for calculated trades. Okay, again, our standard core setup trades that we have are setups. Okay, we want to stay in agreement with the underlying dynamics of strength. All right, bullish or bearish. What these levels provide for professional traders out there is guidelines similar to like the initial balance and so forth. Okay, answers the question, what's the current average daily range, right? How wide is the range? Again, the wider the range, the better the trade opportunities with some increased volatility. But they want to know, what the distance of an ADR is, so they can refine, their trading to say, okay, I'm taking a long position and I'm looking to get 75% of an average daily range. So when price reaches 75% of an average daily range, all right, some professionals out there will lighten up their position. Now again, I'm talking about bigger contract type traders, right? Professional money managers that establish positions. Okay, on the day, they're not tick traders, they're not in and out type traders. But what I want to know is, as a professional, all right, and as our group as a professional, what is the distance of an average daily range? Because there are times when prices will reach that 10 handle rule or that 100% ADR or 75%, and prices will stop and reverse. Okay, so we want to be aware of what professionals are looking at, so we can be a greater informed trader ourselves. Okay, so this is simply referred to as the ADR method, okay, of establishing price targets, and it's effective for professional traders out there. Okay, let me get to, we have 3 more, and I'd like to get to before we end the session here, and I think we'll be able to get it to it within the hour. Okay, the next component we'll take a look at is the D-level money box, DLMB, and this calculates the 113.5, 127.2, and the 138.2 range extension levels based upon the prior day's high-low range. Now, this is a static indicator. All right, it begins painting at the beginning of the session, and it's calculated simply based upon the prior day's high-low range. Okay, so I've noted here yesterday's high-low range, these white horizontal lines. Okay, and simply the D level is the 113 extension. All right, and then the money box represents the 1272382. Okay, real easy to calculate. All right, and we got the midpoint of that range. All right, calculating. All right, simply many times prices will expand or rather extend. All right, not so much expand, but extend beyond the prior day's range. Okay, and really a good case in point here is right here. Okay, today's session, yesterday's high, prices extended slightly above the prior day's range. Now, many times traders will take that as a breakout. Okay, that's not a breakout. All right, that is a range extension. Okay, or what we refer to in the membership as a probe. Okay, above the prior day's high. many times, what's sitting above prior day's highs? What's sitting on the order book, right, below prior day's lows? Stop orders. Okay, so there's there's a saying in the market that no stop goes unfilled. Okay, so what they try to do, the big boys, right, is that they probe the prior high or they'll probe the prior low, and many times they just want to see if there's any stop orders out there. And many times retail type traders will have their stop orders just slightly above the high or slightly below the low. That's not the best way to use stop orders, but many people are out there doing that. What we simply want to use these D level and money box zones are, first, the D level is an interesting level because if the price action is only a probe above or below a high, many times it'll probe up to the D level or down to the D level, okay, and fail to go much higher. All right, it may kind of penetrate it a little bit, but fail to go much higher. If that's the case, and it was only a stop probe, all right, usually a reversal happens. Okay, so we don't know for a fact whether or not it's going to be just a stop probe or something bigger in development. The initial assumption is it's usually going to be a stop probe, all right, until they're able to prove that they can get beyond the D level and hold the D level. Again, the idea, think about the idea of penetrate, okay, and then convert, okay. That type of scenario. Okay, we talk about this a lot. And if it's just the probe and failure to get through that D level, all right, many times a reversal takes place. All right, so we want to be aware of what that static D level is based upon the prior day's high-low range, and we want to use this as a potential for an opportunity to trade. These are key points that we talk about. All right, I'll say to the members, here's the D level. All right, watch for an opportunity at that D level, okay, for a potential reversal. So this is what I'm talking about. I'm talking about that prices are probing through a prior level, and again, I don't know if there's no guarantee, but we're looking for a failure to get beyond that D level. If we see in the dynamic action live that there's a rejection there, it could set up a nice reversal trade, all right, for us in the room. Okay, again, these are what I refer to as price trade setups at price edges, okay, or price edge trades. These are advanced in terms of they're a non-core, they're not a stacker, they're not a premium or a discount, but they could have a component of a premium or discount, in them at the time, all right, on the CCI indicator. Now, we would have to go down to our tick charts to determine that. All right. Secondarily, the money box is primarily used for targets. So if price is able to penetrate and convert, let's just say, the D level here, okay, there's a good chance that prices will extend, okay, up to into the money box zone. And there's a high propensity for price, all right, many times to find supply or resistance or demand, if it's to the downside, within the context of the money box, all right. If there is an opportunity to, if it's more than a probe, and we're able to buy a pullback here, okay, then our targets would be somewhere within the context of the money box. So, you could take a look at here, a pullback to say 37.25, 37.5, with a target up into the 40s. All right, so again, we look for our 2-point, 3-point type rotations, and we could get up into the money box. Again, it's a way of determining a target, all right, based upon extension of the prior day's range. Many times what happens, and again, nothing's guaranteed, but many times what happens once prices reach a money box zone after a period of time, you could get a a reversal off of that money box zone. Okay, now it's not going to happen every time that way, but that's always something that we want to be aware of, and we want to look for the informational market data clues that will tune us into something like that. So first and foremost, the D level is used for stop probes. Okay, can set up a nice reversal opportunity. If the D level is penetrated and converted, the probabilities favor a move into the money box zone. Now, taking individually, we're just discussing the money box D level. Starting to layer stat X zones, target master levels, and initial balance zones, perhaps, right? The targets off the initial balance and the opening range starts to build zones of confluence. Okay, so overlapping zones or levels, but based upon different calculations. Okay, and that's where, which one, we were asked a little bit earlier, which one's the most important. Okay, there isn't one that's most important. What we want to do is build a zone. If there are overlapping zones, we want to use those as more important zones of potential resistance supply targets. Okay, so this is a static one. One interesting feature, I believe, let's see, let me take a quick look on this one. All right, not sure on this one. Yeah, I'm not sure. What we can do here on the D-level money box indicator is we can actually project tomorrow's levels, all right, today. In other words, this current range today, okay, we can change the values and project what the D-level money box will be tomorrow, the static D-level money box, and that can help us for planning purposes. Okay, but this will begin painting right at 9:31, and it'll give us all the necessary values that are required. Okay, the next balance chart component is called the target master, and this displays a normalized 3 to 5 day range, and with some specific proprietary calculated breakout and breakdown price levels. Okay, so simply what we do here is we take it's a proprietary calculation of values between 3 and 5 days. Okay, there's something called the 3-day cycle. All right, prices tend to rotate within cycles of 3 days, but they can have what we do is we take that and we normalize it to a 5-day period. Okay, and we take a 5-day normalized range, and again, these are proprietary calculations, and then what we do is we place percentage values on that. Okay, so simply what we do is we calculate from the opening price, okay, and that's the yellow line, the opening price, and then once we have the opening price, we're able to then, the algorithm calculates automatically for us 3 levels to the upside, 3 levels to the downside. So the inner levels, which are simply called the breakout level or breakdown level, these are the inner levels. Okay, these are the ones that have the highest percentage of getting hit, okay, to the upside or to the downside at some point, during the day. Okay, so these are always high probability price targets. Okay, now again, sometimes they're 3, 4, or 5 points, from the opening. Okay, so they can, offer some very interesting targets. Many times, these are the higher probability ones. As you go out in the next level, so the idea here would be if this level gets converted, so let's just say to the upside, all right, and again, we had quite a strong day today, all right. If the upside here, 37 quarter, all right, was penetrated, all right, and let's just say we didn't get much of a pullback, but it held above the initial breakout level. Okay, probabilities then favor very strongly to reach the next level. Okay, and if that level is penetrated as well, all right, there's even a greater probability. Again, probabilities actually increase rather than decrease. They increase that the next breakout target is going to get filled. So take a quick look at the one here yesterday. Okay, so yesterday, all right, this was the high probability one right here. All right, got broken. Okay, reached the next target. All right, and although we had a deep pullback here, prices recovered, all right, through the initial breakout level, and then again back up and tested the breakout level 1. Okay, and once this occurred, there was a very high probability that the ultimate breakout target, okay, would get achieved. All right, so this particular one is interesting in that the conventional wisdom would be it would be harder to reach the outer targets, okay, the outer boundaries. So I mentioned that these are the higher probability ones, that they will usually get hit quite often during the day. So I kind of refer to these as minor levels. But the interesting part of this particular method, okay, for projecting targets, all right, so this is actually increasing probabilities. So if the breakout level gets broken and converts, the probabilities are, there's a certain handicap within the context of this, but there's a good probability that the next level is going to get hit. And again, as I mentioned, if that one does not elicit a sell response, because it may, all right, but their targets first, there's a high probability that the next one, even higher probability, so you can think of it as there's almost an 80% probability that the initial levels, all right, are going to get hit at some point. Okay. Okay. Is that worthy of a trade? Is there an opportunity we can do there? Perhaps. Okay. But for the most part, that there's a good chance. If prices break up through the next one, okay, there's a high probability. There's probably a 73% probability, I believe the handicap is 73% probability that the next level will get hit. And if that level gets penetrated, I think there's a 92% chance. Right, nothing's 100. There's a 92% chance of the upside level is going to get, the final breakout target level is going to get hit. So this is again another layer that we can use. And again, I don't want to get everybody confused here in terms of so many levels, so many targets, and so forth. Again, we use these as confluent zones. We trade price, we trade the direction as we do on a day-to-day basis, all right, but these are targets, these are zones that we hit almost on a day-to-day basis, all right. There's always going to be some zone we're going to hit, and I want to know, based upon how the professionals, and I've learned how to use target these over the years. All right, these are levels that pros from the investment banks use. Okay, you won't see these levels anywhere. All right, so again, it's another component that goes into building the balance chart. Okay, and we have a few minutes left, and we'll finalize with the last indicator here for the balance chart. Okay, so the last indicator in the balance chart components is what we refer to as the volume trend histories, or VTHIST. And simply what this is, it calculates and displays 10 days of histories of the volume trend point of control. And these are also referred to as the high volume nodes, which are the greatest single price point of acceptance between buyers and sellers. Okay, so let's take a look at, first off, today's VT, or volume trend. Some people also refer to it as the VWAP. Okay, we simply use the term volume trend. And today's closing volume trend is 1939. The upper value area, so again, we have components of the market profile that many people use. So dynamically created, the UVA stands for upper value area, and then the LVA, lower value area, and that constitutes 70% of the volume traded throughout the session. All right. 2 SDs stands for 2 standard deviations, and 3 SDs, 3 standard deviations away from the volume trend. Now this is a closing value here. Okay. The display is very columnized or line oriented here. Some other displays we can use as what we call squiggly lines. All right, but I like this display, and this displays the throughout the course of the session, this displays the current volume trend, upper value area, lower value area, not the trends of them throughout the day, but the actual value at that time. All that's really necessary is, when you're trading the right edge, well, what's the current value volume trend, what's the current upper value area, lower value area? Okay, so that generates the dynamic one throughout the day. Now this is volume trend 0. Okay, think about this, volume trend 0. All right, yesterday's volume trend 0 is today's volume trend VT history 1. So yesterday's closing volume trend is 1931 quarter. Okay, the 2-day volume trend close 2 days back is VT history 2, 1928.75. Okay, and so forth through up to 10 days. Okay, now there's no particular reason why we have 10 days. We can use 5 days. Okay, typically I can calculate up to 100 days, but it doesn't really matter. 10 days is kind of a normalized 2-week period. But again, what we want to glean from this is a couple things. Instead of having a bunch of profiles overlapping each other, okay, on the scale here, we simply have a very clean display of understanding where is the highest volume node, where is the highest single point of acceptance on each day, looking back 10 days. And you can see here there are various points. What we really get out of this is there's many times you'll have several days that overlap each other, okay, and they cluster. So you'll see here looks like day 3, 9, and looks like perhaps 4 in there. Okay, so there was an overlapping zone there. So this 1926, all right, if you understand that this is the highest volume node, okay, for for the day, the volume trend at the close, this is an important level. This is an important zone. Okay, so it's never one price point. It's always a zone. So this just simply looks back 10 days. Okay, and if you want to know, what are some key price points, right? X number of days, back in terms of volume trend. This is an easy, quick answer to get. All right. Prices tend to return back to high volume levels. Okay. This is where we, or between volume zones, and this is where we look for opportunities, all right, to take trades, because again, the markets are very structured. This is not, it seems like it's chaotic, but it really isn't. Okay. The idea when we trade is, although we do use our execution charts quite a bit, I still want to know what the key levels are, and if I can bring together, all right, several components that generates an important zone, okay, I'll have a greater confidence level of expecting a response from buyers or sellers, whichever the case may be, when prices return back to key levels. Okay, and if those levels ultimately don't hold, then the market is giving us some feedback of what its what its view is of the current price zone. Okay, is the price zone being accepted? Is the price zone being rejected? That can set up some very key trade opportunities for us. Okay, so so I think there's about 10 components here or so of the balance chart that we've gone over today. Okay, what you may want to do is just review this video in the future a few times. Okay, and try to just simply get an understanding. This video is an introduction to the balance chart components and definitions, and I didn't go over every opportunity that we use it for because it's really beyond the scope of the initial video. But we use these levels and building a picture of important key zones based upon different elements in calculations. Okay, please repeat what the SD means and had to step out for a minute. Sure. The standard deviation, okay, that's simply SD stands for standard deviation. So from the volume trend point of control, or the VWAP, all right, in a normal distribution, their prices are typically distributed within 70% or one standard deviation, all right, above and below the point of control. Okay, so that the value area is that 70% of the majority of the volume. Okay, it does not have to be the highest volume node, all right, but it's the 70% of all the total volume on that particular day. Now that's one standard deviation, all right, away from above and below. 2 standard deviation, again, it's a mathematical formula. 2 standard deviation and then 3 standard deviation. I think 2 standard deviation encompasses about 95% of all the volume within the context of the distribution. Okay, and then the 3 standard deviations, which is not normally achieved because that's like an outlier. Okay, so the majority of the trade typically is going to trade within that plus 1 standard deviation zone and slightly beyond it, and within the context of 2 standard deviations. All right, so on a normalized basis, what you would be looking to use these for, again, if in a non-trend condition. Again, this was a breakout today, but it's pretty aggressive in one direction. So this isn't, although this is a trend up, it's not a it is a trend, but it's not a slow moving trend. So when prices exceed the upper value area, it's statistically speaking, all right, it gets extended. Okay, and so unless many times the markets can revert back to the mean. All right, and again, there's no guarantee that it will, but if it does, it's usually going to happen near to the 2 standard deviation level, because now we're talking 95% of all the volume between the upper standard deviation and lower standard deviation. Okay, all right. These UVAs and LVAs are dynamic for the day, for the current day. Okay, they calculate live from the beginning, all right, throughout the course of the day. So they're also referred to as the developing upper and lower value area. And then at the end of the day, so the market's closed now, all right, these are the final readings of the value area high, value area upper, and value area lower for the day. Now, on our indicators, I have an indicator that displays the prior day's upper and lower value area as well, but I feel at this point that's overkill. You don't need to know what necessarily the upper and lower value is for the prior day, or 3 days back, or 5 days back. Simply, you can visualize the high volume area, the volume trend for that day, and know that there's an upper and lower zone. all right, above or below that VT history. Okay, so the most important level is the volume trend, all right, the single point for the day, and so we look to build a a confluence of zones as such. Okay, so let me take one moment and let me build the final look of the balance chart. Okay, we've taken the balance chart apart individually, and now I just want to show it fully built with all the indicators on it. And it will be a little messy, but you'll see how we can build and display some of these zones. Okay, in our final display of the balance chart, what we've done is we've taken all those individual components we've just gone over and we've overlaid them all on the same chart. Now this can look really messy, okay, and so my recommendation is for those using the balance chart is to review it individually, all right. Most of these, for instance, early in the morning, the initial opening range rotation will be the only opening range indicator that's painting after the first 5 minutes. Okay, the initial balance or the opening range indicator won't be on the chart yet, so it'll be less messy, all right, at the beginning of the day. But as the dynamics of the market builds, okay, the next 30 minutes and then the initial balance, okay, these targets begin to paint. So you can see here on the right hand side OR1, opening range target 2, all right, initial balance target 2, okay, initial balance midpoint, opening range midpoint, okay, the midpoint there. So it builds a framework okay, of trade, of zones throughout the course of the day. Now today, of course, we got a monster breakout here, okay, but this is what it looks like. Now I would recommend for everybody to use this in piecemeal. If you wanted to know what the 10-day average daily range is, take the others off, all right, and put the average daily range on. If you want to just look what the initial balance is, put the initial balance on. Okay, so this is very flexible. All right, I know it can get real confusing for many, and you see a whole bunch of lines, and you don't know, where's the money box? I can't see the money box. Okay, well, if you can't see the money box, clean up the chart a little bit so you can see what the money box values, are. Okay, this is meant to be used dynamically, right, by each trader. Not you can overlay them all, but you can not, once you know what the 10-day average daily range is, you can take that off. You can clean up the chart a little bit, or you can make it as messy as you want. I particularly like clean charts, but the balance chart is our single most comprehensive chart that offers us every conceivable level that professionals, money managers, traders, institutions, hedge funds use. Okay? Now, after you've gotten a little comfortable viewing them, working with them, understanding what what they're telling us, okay, they over time they can become very, very valuable. Okay, again, we want to keep things simple, but we also want to make sure that we have robust levels and targets that professionals use. Okay, when you get high confluence of zones, okay, clustering together, okay, they tend to let me just go back here a little bit in history. Okay, you can see how this pullback here to the opening range. All right, we'd be looking for an opportunity to to buy this. Okay, having gotten above the 30-minute high, projected 30-minute targets. Okay, so you can see there's an overlap of the 30-minute and initial balance targets. So the idea is once you get past the 30-minute, all right, the initial balance becomes more important, so you can disable the 30-minute opening range, okay, because now you want to use the initial balance when that becomes the more important level, okay. Levels such as the ADR and the money box, okay, they'll tell you what the calculations are, and you can choose to leave them on the charts or disable them if you wish. Okay, so again, a lot of information, all very useful, but we need to just understand the context. So as the education progresses here for you at Polaris, we'll learn how to use these levels more practically. This intro video to the balance chart components is simply just that. It's an intro video defining the key levels, and then now the dynamics of the education will bring in various components of the balance chart, which I will mention throughout the trade session. And now following this video presentation, our members will have at least an initial understanding of what the components are, and hopefully that will help us get a clear understanding of why prices are responding from these key levels. Okay, so this will conclude this presentation of the balance chart components. We've gone about an hour and 16 minutes, so well within our time slot allotted. And I want to thank you for attending today. And we will this will be recorded as it is, and we will also have a document for the PowerPoint, so the individual definitions of each of the segments of the balance chart is available to you on the website. All right, so thank you very much for your attendance, and we will see everybody at the next Wednesday Workshop Educational Series program. Thanks, everybody, and good trading.